Hello, and thank you for joining us this afternoon. We're just waiting on a few more people, so please give us a few minutes and we'll get started promptly. Hello, everyone, and welcome to today's webinar, Keeping Current, Trends, Strategies, and Advice for Your Everyday. I'm Pablo Fuchs, editor of Globe Advisor at the Globe and Mail, and the moderator for today's discussion. Before we begin, I'd like to cover a few housekeeping items. There are various application widgets you can use at the bottom of your audience console. If you have any questions during the webcast, you can click on the Q&A widget at the bottom and submit your question. We will try to answer them live during the webcast. But if a fuller answer is needed or we run out of time, our speakers and sponsors will do their best to follow up. We capture all questions. You can expand your slide area by clicking on the Maximize icon on the top right of the slide area or by dragging the bottom right corner of the slide area. If you have any technical difficulties, please click on the Help widget. It has a question mark icon and covers the most common technical issues. An on-demand version of the webcast will be available approximately 1 day after the webcast and can be accessed using the same audience link that was sent to you earlier and allowing you to access the live webinar now. On to our webinar. I'm pleased to be joined by three very insightful panelists. Rodrigo Gordillo is co-founder, president, managing partner, and portfolio manager at Resolve Asset Management and has more than 15 years of experience in investment management. He has co-authored the book Adaptive Asset Allocation, Dynamic Global Portfolios to Profit in Good Times and Bad, as well as several white papers and research focused on adding new insights to the quantitative global asset allocation space. Rodrigo began his career on the institutional side with John Hancock before transitioning to the ultra-high net worth space at a boutique wealth management firm. Subsequently, Rodrigo, along with his partners, Mike Philberg and Adam Butler, continue to evolve their quantitatively focused investment methodology as portfolio managers at Macquarie Private Wealth and Dundee Goodman Private Wealth before launching Resolve Asset Management in 2015. Daniel Straus is Director, ETFs and Financial Products Research at National Bank of Canada Financial Markets, overseeing the ETF Research and Strategy Group, which focuses on providing both institutional and retail investors with a value-add and actionable investment research relating to exchange-traded funds. Daniel joined National Bank's ETF Research Group as a research associate in 2010 and was promoted to director in 2020. He holds a bachelor's degree in applied science and engineering from the University of Toronto, a PhD in engineering from Brown University in Providence, Rhode Island, and a Master of Finance degree from the Schulich School of Business. Robert Duncan is Senior Vice President and Portfolio Manager at Forstrong Global Management. He's responsible for advancing sub-advisory relationships with pensions, foundations, endowments, family offices, and broker-dealer platforms, as well as for managing Forstrong's institutional client base. Prior to joining Forstrong in 2018, he was Vice President at BlackRock, leading its iShares institutional business in Canada. Robert has a Bachelor of Economics from Concordia University and holds a Chartered Financial Analyst designation. Let's start this discussion by taking a macro look at Canada's ETF sector. Daniel, your team's monthly flows report are required reading for anyone interested in keeping track of ETF's dramatic growth during the past decade. But we've also seen some significant changes since COVID-19 first hit, especially with fixed income, oil, and gold ETFs. Can you walk us through what has transpired during the past few months?
Sure. Thanks, Pablo, and thanks also to everyone attending and for your attention. I see that we still have our photo slides up there, and I promise to everyone viewing that I don't actually have the most swelled head amongst all of us. It's just that the picture is a little bit stretched, I promise. But thank you. This is what I'm going to talk about today, just for the first few minutes before I pass it off to my esteemed co-panelists, and then we can get into an open discussion because I'm also very eager to hear from them. I'm just going to give a quick intro and background to the way ETFs have been growing and trending in Canada for the past 10 years or so, before pivoting to a very kind of fine-grained look at three very interesting sub-pockets of the market in the aftermath of the kind of corona-apocalypse pandemic sell-off that we're all, I guess, still living through. If you can say that the recovery is over already, I'm not quite sure. But Pablo, if you don't mind, let's go right into the meat of the material. Next slide, please. So here is how ETFs have been growing in Canada and globally. It's not specifically broken down on the chart, but in the US alone, assets are north of 4 trillion. They're actually 4.4 trillion now. With the market recovery that's been going on, there's over 2,000, there's really more like 2,300 products. In Canada, we crossed the $2 billion milestone in November 2019. And then after dipping below, we're now back above with listed AUM of 211 billion and nearly 1,000 ETFs. In fact, we manage our database on a day-to-day basis, and we're anxiously anticipating that 1,000 product milestone in Canada. This is double-digit asset growth in the ETF space. It's a 20% CAGR in Canada for the past 5 years and the past 10 years. It's really an astonishing, eye-watering pace of growth with really no end in sight. We keep wondering when that plateau will hit, and we haven't really seen any evidence of it yet. And on the next slide, Pablo, if you don't mind moving to slide 5, is one of the reasons why, and that is because everyone is joining the fray. Yes, there's a lot of demand to buy ETFs, but there's also a lot of demand to sell them. Asset managers, large and small, have come to realize that ETFs are the way of the future. All sorts of firms are coming to offer ETFs, boutique managers, fresh startups, established mutual fund companies. You can see all the logos acting as a real kind of car crash on the side in the last number of years. Mutual fund companies, insurance companies, all of the 6 banks, including National Bank Investments, a sister subsidiary of National Bank Financial Markets, the company I work for, they all offer ETFs now. There are 37, I believe, ETF providers in Canada, and soon to be more. So where are the assets coming from? Where are all these new assets pouring in from? Are ETFs cannibalizing mutual fund assets in Canada? And the answer to that is, well, let's go to the next slide. And I can talk about it a little bit, Pablo. There you have it. If you had asked me prior to 2018, I would have said that there's really no evidence yet that the ETFs are cannibalizing mutual fund assets. But if you look at 2018, 2019, and 2020 year to date, there has been a shift in investor behavior. And time doesn't really allow for me to get into this too deeply and compare with, let's say, the US. But I could just mention that in the US, ETFs have been outselling mutual funds every year since the global financial crisis. The 2008-09 crisis really kind of kick-started a shift in investor behavior. Investors across the United States woke up to a new world of cost consciousness. If you can lose 40 to 50% of your portfolio in a single quarter, then why are you paying an active manager, 2% a year, somebody who, could, with the active compounding, end up kind of siphoning off fully half or if not more of your wealth, considering that now you can get the same sort of index exposure very, very cheaply. I believe that kind of inflection point has recently been reached in Canada, and the corona-apocalypse, the coronavirus pandemic sell-off, that has kind of further solidified that trend. So ETF asset growth, investor adoption is a runaway snowball. It's tumbling down the mountain. We see no plateau to the growth ahead. Now, on the next set of slides, Pablo, if you don't mind, there's three pockets of the market that I teased off at the beginning as showing some particularly interesting phenomena. And the first one, of course, is bonds. There were 2 weeks in March that were very hairy and scary for bond investors, bond traders, fixed income portfolio managers, and bond ETF investors. In fact, the only ones who probably navigated that very turbulent time smoothly without many lost hours of sleep were mutual fund investors, and that's because their NAVs did not really show market declines if they were holding corporate bond mutual funds or even aggregate bond mutual funds. And the reason for that is the NAV pricing, the way that the bond pricing world works is that third-party pricing agencies are submitting data points and marks for bonds that may not have traded for days. And this model works just fine in normal conditions, but it's happened before, for instance, the 08-09 crisis, when bond pricing agencies kind of decouple from reality, and when you want rubber to hit the road and actual trades to take place, the same bond dealers who are submitting theoretical quotes aren't really there to transact. There's no bid, the market dries up, and ETFs, in fact, end up acting as the price discovery vehicle. So what you see in this chart here, we wrote a whole report on it. I'm happy to share with anybody who reaches out to me after this webinar. But there were ETFs out there that for a couple of days were at apparent, and I say apparent very conspicuously, apparent discounts of 10 to 15% for a couple of days, because the ETF market makers really had no idea how to hedge the underlying portfolios and were really taking on risk. Was this a black eye? Is this something that indelibly mars the reputation of ETFs as the go-to investment for investors of the future? I don't think so, because number one, this was a predictable outcome, and it has in fact happened before. Investors weren't really harmed on paper if they rode this period out. They may have been harmed if they actually sold their ETFs at a discount, but then again, they achieved liquidity when, in fact, such liquidity was very hard to come by. And when we look at the next slide, Pablo, if you don't mind advancing, we kind of go through in detail a single day in the life of ZAG. This was pretty typical of what happened. A huge number of shares traded throughout the day. There was a trading halt, and then the market started to slide. Everywhere risk entered the system. There was an enormous cloud of uncertainty around bond prices. But what happened was that less than 1% of the shares that day traded at this closing price, which is well below NAV. The vast majority of shares happened above that. So if you look at the average discounts to NAV through that 2-week period in March, you might say it looked like they were 5 to 10% discounts. When we do what we call our VWAP, weighted discounts, and see what really investors paid for intraday liquidity relative to NAVs, it really was just like 1.4% of the total volume traded, which is a perfectly reasonable haircut to take for accessing instantaneous liquidity in a market where nobody knows what's happening. So that was fixed income, and it really just kind of scratches the surface of the very kind of technical and microstructural details we observed there. Moving on to the next slide, I'll talk very quickly about oil. USO, we got a million questions on that. Retail investors really were piling into this because it's called U.S. Oil Fund, and they think, well, this is a fund, it's called U.S. Oil Fund, it must hold oil. It doesn't hold oil, no fund can, it holds oil futures. And the May futures contract went negative. I should point out it went negative after USO had already done its contract roll. So no investors or fund were impacted by negative futures prices. But because that's theoretically possible, and because of the storage gluts, again, brought about by a completely shut down economy, the managers of USO had no choice but to completely change the mandate of the fund and buy out a whole calendar strip of forward contracts going down the calendar curve. Oil since recovered, this fund is not going anywhere, and it's perfectly stable, but it was a really, really interesting experience where we entered some really uncharted waters. And I guess the message I would leave with clients and anybody listening is that we always have to stress a futures-based ETF will have contango and backwardation baked into it, which will overlay your returns. So it's something worth understanding. And a futures-based ETF really, for commodities that are in persistent contango, not really always an appropriate long-term hold unless you really understand how those markets work. Moving on, and I can talk a little bit about gold. it's one of the brighter spots. You know, gold was a big narrative after the 08-09 crisis skyrocketed to, close to $2,000 an ounce. Went back down. Everybody was thinking that inflation with all these Fed interventions was going to be the name of the game and that the US dollar would weaken in the subsequent years. But no, in fact, that didn't play out. But now the Fed is intervening again in ways that are, again, unprecedented. In fact, in even buying fixed income ETFs to stabilize the underlying US corporate bond market. And gold is diverging from the S&P 500 in a way that you want to see if you are using it as an alternative asset class and you need some diversification. The last 2 months in Canada were some of the highest inflow months for gold and gold miner ETFs. We observed a couple $100 million go into the combined class of gold bullion and gold miners, which was the second highest in history. And then again in May, the third highest. So as you can see on this chart here on the right, those two clusters of bars really show that the investor appetite for gold has picked up, and gold did deliver some correlated outperformance during those times when the blue line, the S&P 500, declined quite sharply. So between gold, bonds, and oil, three really interesting stories that kind of play into everybody's market outlook. And I'm really curious and eager to hear how the subsequent panelists can play with those in ways that may help, or maybe even avoid those in ways that help clients. So that's it for my introductory remarks. Pablo, I'll hand it back off to you to introduce our next speaker.
Yeah, thanks a lot, Daniel. I'll turn it to Rodrigo now. Rodrigo, in light of all these changes during the past 3+ months, which have felt like a couple of decades actually, how have you and your team at Resolve been recalibrating portfolios to withstand the volatility that we've all been experiencing?
Well, that's a very good question because our team is so that everybody knows kind of our background, we are a 100% rules-driven quantitative firm. And the decisions that we have made for how we manage money have been made years in advance, doing very deep empirical research and understanding the fundamental drivers of the economy. And so we really depend mostly on preparation rather than try to repositioning on the spot, right? So we're not reacting, we are proactive, given all the research on beforehand. And so I would say that the most important thing that we try to convey is, and I'll actually quote Peter Bernstein because he says it best. And his quote is that survival is the only road to riches. Let me say that again. Survival is the only road to riches. That is what diversification is for. It's an explicit recognition of our ignorance. And I think that never before have we had the proper tools to diversify in the right way in order to avoid and thrive even during periods like this COVID-19 disaster. So anyway, that's kind of like an intro as to what I want to focus on today. And a lot of this research that we do, we're very prolific in our content. We've written a bunch of white papers that are, in the #1 most downloaded research on the Social Science Research Network. We've made our research more approachable recently by creating a couple podcast series, the Gestalt University podcast or the 12 Days of Investment Wisdom. Anybody can find these by just typing in Resolve in their favorite podcast player, okay? And then our book that we published in 2015 will have a lot of these concepts that I'm going to kind of talk everybody through. So I think if we go to the next slide, I'll kind of expand a little bit on what I mean by being prepared, right? Preparation before prediction. And this comes back to any one of these asset classes that you'll see in this target chart can be replicated by exchange traded funds, okay? But what this chart is trying to show is the dynamics between inflation and growth. So rising inflation or slowing inflation is in the north-south arrow, and slowing growth is in the east-west. Slowing growth to accelerating growth is in the east-west arrow. And the intersection between these two dynamics, if you look at history and understand fundamentally what these asset classes are for and all about, what you end up finding is that depending on what economic regime we're in, we can predictably know what asset classes are likely to thrive, right? And it's all generally intuitive. If you think about periods of accelerating inflation shocks and accelerating growth shocks like we saw from 1999 to 2007, that was a period where if you had told me up front that it was going to be a series of inflation shocks and a series of growth shocks, I could have told you very confidently that emerging markets, emerging market real estate, gold, commodities, emerging bonds were going to be the big winners in this period, inflation-protected bonds and so on. If you would have told me the period from 1981, when Volcker broke the back of inflation, and rates continued to go down, slowing inflationary shocks while accelerating growth was going to be the regime, then I would have told you that developed equities and bonds were the place to be. And similarly, in periods like 08 or last couple of months, of slowing growth shocks and slowing inflation, then going long treasuries and gold would have been the place to be. And ultimately, the top left quadrant here, this inflationary stagnation, is going to be affected by. It's going to benefit from inflation and growth. What are those things going to be? It's going to be gold, commodities, emerging bonds, spreads, and inflation-protected bonds. Okay, so with this framework, we move forward into trying to deal with situations like these. And before I continue, I just want to make sure there's some background noise. I don't know who's not muted, but if you can mute that, that would be helpful. Okay, so if we go to the next slide, this is just a representation of how asset classes respond to different regimes, right? So you can see that in a period of the 70s, had you owned gold and commodities, you would have done really, really well, but you would have basically flatlined with your bonds and your equities, right? And the period on the bottom left, like 08, equities were down, gold and treasuries were up. Disinflationary boom, the 60-40 portfolio, that's the bottom right, would have done well. And in the early 2000s, it was the BRIC countries, right? Brazil, Russia, India, China, commodities, gold, that were the winners. So these are kind of secular trends that we understand that these dynamics work. But the truth is that we don't have to wait decades for this to play out. These inflation and growth dynamics play out on a year-to-year basis. So if we go to the next slide, the slide might be a little tough to see, but just try to see the different colors. And what we've done here is from 2000 to 2018, color coordinated the big winners and the big losers. Okay, and what you find is that every year there are big double-digit winners and big double-digit losers that move up and down depending on these dynamics. And the question is, if this is true, and all these asset classes have an expected positive risk premium, then what is, from the perspective of maximum diversification and survival, as Peter Bernstein said it, what is the best approach? And just to highlight a few things, in 2000, when we had the tech bubble, and a lot of retail investors lost money, had you already been in commodities, in REITs, in treasuries, in T-bonds, in German bonds, in UK gilts, in the U dollar, you would have been okay. You would have been making double-digit returns. In 08, U dollar, treasuries, if you bought the US-based TLT, you would have been up 65% in 08, right? So it's not all equities, and it shouldn't be all equities all the time. So if we go to the next slide, under the understanding of trying to maximize our diversification, the first thing that comes to mind to most investors is, okay, maybe I should equal weight these things, right? So on the left-hand side of this slide is the idea of equal weighting. The first kind of color is bonds, the second color is commodities, the third color is equities, and the last color is REITs. But the problem, this is a very key aspect about true diversification, is that if you equal weight these things, but some asset classes have 5 times the volatility of others, if we equal dollar weight, are we actually in balance? And what we find on the right-hand side here is that this is the red bar represents volatility of a portfolio like this. And each individual bar here represents the risk that it contributes to a portfolio. And we see that the risk is dominated here by real estate, which is heavily levered, and equities, which are heavily levered. So the way we look at things is we look at things in the next slide from the perspective of risk balance. We call this risk parity. So we want to give more capital to asset classes that have lower volatility and less capital to asset classes that have more volatility, so that when I put my risk parity goggles on, which is on the right-hand side, the up and down daily movement of those asset classes have equal contribution. We don't want the maniacs to take over the asylum. We want to have everybody contributing the same amount of risk to the portfolio. Okay, and you can see that the red bar now goes from 13% volatility to 7. And if you go to the next slide, this is an index that we created with the S&P Dow Jones guys that shows what balance looks like over time, right? So if we were to be prepared rather than predict, what you end up getting is the Canadian market is just, because we're speaking to Canadians, there's a lot of noise around that signal, right? And diversification seems to allow investors to survive and thrive, right? It is actually, as Bernstein said, it's the only way to riches. You can see even in the last quarter, in fact, we can show it in the next slide. This is 2020 in the next slide. So we've been talking about this for years here at Resolve, and you can see predictably that in this chaos, gold and treasuries were there to protect. Okay, if you go to the next slide, this is what our live 6% volatility risk parity portfolio did, right? So again, just to kind of bring it full circle, how are we positioned? How did we transition? When it comes to this idea of diversification, from an asset class perspective, these are portfolios that investors can use current Canadian-based ETFs, the U.S. Treasury ETF that didn't used to be available back in 2008. Horizons now has it, and I think it's HTB, and you can use that as part of your diversified portfolio. It can create the type of balance that we're seeing here, right? For a risk parity investor, it's a non-event. Okay, I'll leave you with a final thought. The question is risk parity appropriate for everybody? Well, no. There's a subset of the population that has a little bit of hubris, and does want to reposition in a thoughtful way. And so, if you go to the next slide, we're going to talk a little bit about pushing the boundaries of diversification. So we always talk about one thing being asset class diversification and how to do it properly. We've written a ton on that. That's one area. Then the next question is, can we actually add a tinge of prediction? Can we actually overweight and underweight these asset classes over time to get a better result? And we believe we can, but again, everything is not about trying to predict what's going to happen in the future. We're not very good at that. We're not global macro managers. We're systematic managers, and therefore identifying anomalies. We've all heard of factor investing. We've heard of momentum, value. We've heard of lowball, quality ETFs out there on the security selection space. We don't pick stocks. We look at global asset classes, and those same factors exist in the asset allocation space. And so we wrote a paper called Global Risk Parity with Macro Factors. If anybody's interested, you can download it in this presentation, and you'll be able to read through it and understand what it is. But it's allowing us to have tilts. And if you go to the next slide, the tilts that we look at on the macro space are seasonality, momentum, counter trend, carry. And one question that has been asked of us is, given where we are now, which factors should we reposition? Much like people are saying, hey, given where we are now, should we be more overweight equities or underweight equities? Well, the truth is that we don't know whether seasonality, counter trend, carry, momentum, and in the equity and the security selection space, whether it's low vol or value or momentum is going to do better. We are claiming ignorance on the factor space. And therefore, and in the next slide, you can see that it's appropriate to do that, because these just represent major drawdowns in equity markets from 1990 to today, and every single event is different, and every single event, different factors do differently. So the key takeaway from all of this, guys, in the next slide, and I'll leave it open for questions after, is under heightened uncertainty, we need to prioritize maximum asset class diversification, in our opinion. And then when you're looking at different ways of investing and having less preparation and more prediction through your active ETFs and your active managers, can you really predict whether one manager is going to do better over the next 3 to 6 months and another? Our view is no. And so you want to also maximize your diversification across those strategies. And right now we have a bunch of separately managed accounts that we run live for Canadian investors. In the next few months, we'll be launching the idea of risk parity plus factors in Canada and a little bit of tail protection. So keep your eye out for that. But the idea here is diversify across these factors. And then we also make sure that or everybody should make sure that, the same, when you're buying and selling in stocks or ETFs, when volatility is 5 times what it used to be, you might want to reduce your bet size. And when volatility is really low, you might want to increase it. This is kind of what we also espouse in our research if you guys want to read it later on. So that's kind of my key takeaway ultimately is be prepared and be diversified and focus on that as your number one priority, and then sin a little by looking at different ways of tilting.
Great. Thank you very much, Rodrigo. That was very insightful. Rob, you and your team at Forstrong are taking a very different approach to the current volatility that we're experiencing. Which trends are you keeping an eye on as you construct portfolios to get ahead of the post-lockdown economy?
Yeah, it's a great question, Pablo. I think I'm going to do my best to try and answer that and showcase some of our views today. I think if you take a look at or compare and contrast our presentation with Rodrigo's, it's very interesting to kind of put these together. I wouldn't say that they're polarizing. We both start with the same ideas or same premise, that we both believe in global diversification and focusing on using asset classes from around the world to try and generate some kind of stable and consistent returns. But the big difference is going to be more of a quantitative approach from Rodrigo at Resolve, whereas more qualitative from us here at Forstrong. So before we get started, I just wanted to talk a little bit about Forstrong, because I realized I didn't include much in the bio for intro. Forstrong has been running global macro portfolios in Canada for the better part of 20 years. We've worked exclusively with institutional investors as well as advisors. And as part of the process, we've been big consumers of ETFs, even before ETFs were cool. And ETF portfolios were kind of mainstream, so to speak. For the presentation today, we're going to walk through a couple of our focuses, answer a few questions, and then kind of showcase what we see as being the winners and losers after this lockdown. And if you just jump to the next slide, it'll kick us off. So I'd like to start our presentations off with a quote, and I always think of Winston Churchill when we see market volatility like this, particularly for a pandemic which doesn't occur in anyone's lifetime quite regularly. And quotes, now is not the end, it's not even the beginning of the end, but perhaps it's the end of the beginning. And what we think about this is that this setup is essentially creating a change of leadership or potential change of leadership. And we've seen a lot of these resets happen in markets. If you look back in time to 2011 with the Euro debt crisis, 2015 with energy, even 2018 with regards to trade wars. And what this does, it creates opportunities for reset expectations. And for us, what we try and do is we're trying to predict based on market or macroeconomic forces and policy responses from governments and central banks around the world, how we see these economies changing and where we should be placing our bets from an asset class perspective. From our view, picking the stock and trying and outperform or beat a particular index is very difficult. So for us, we focus exclusively on the asset mix and try and get that right for clients. If you want to jump to the next slide, we'll kind of talk about the 3 things we're going to look at today. We're going to look at kind of where we see as what happens next post-pandemic, how can markets be where they are today, and then where should investors be positioned. Now, before we talk about what's next, I'm actually going to start with kind of how we got here and talk a little bit about pre and post-pandemic and kind of the view of whether we think this is going to be a longer-term shock or whether this is more transitory. If you jump to the next slide, you're going to take a look at market expectations relative to pre-pandemic and post-pandemic. Now, clearly, if you look at where the market has come from in the last month, the recovery has been phenomenal. And if you look at where it was prior to the pandemic, clearly the impact has been detrimental. You are going to see impacts to GDP in the first half of this year that are going to look quite ugly. And we're trying to get a sense of what has been the response and can this be a shorter term or transitory shock versus longer term. And we keep hearing a lot of these views from investors and from portfolio managers around the world. Is this going to be a V-shaped recovery, a U-shaped or W-shaped recovery? And I think that a lot of investor behaviors is taking part or playing a part in a piece of this recovery at present. We're going to talk a little bit about what's been supporting it, but from our view, we see this as more as a transitory shock given the response from government and the policies put in place to support and create conditions for an economic recovery. We're going to showcase a few of what those policy responses look like, but before we do that, we're going to get into a little bit more on the investor behavior, which we do incorporate it as part of our macro beliefs or our macro process. So if you jump to the next slide, now clearly everyone's kind of asking, how can the market be where it is today, given a lot of the turbulence and economic disaster, or even some of the socioeconomic unrest that's currently happening. What people forget is that markets are discounting mechanisms, and they don't really care about what's happening in the present. They can actually very much ignore what's happening and ignore a lot of that noise, and they're really focused on what the world's going to look like in 3 months, 6 months, 12 months down the line. And for this recovery, what we've seen is that the policy response from central banks and governments has been very powerful, very quick to counteract it, but people still don't believe in it. They're very tepid to put money to work. And for some, they've potentially missed a lot of this economic recovery or market recovery that we've seen over the last month. Now, if you take a look at this slide, this is one of our favorites to look at. This is a Bank of America Global Fund Manager survey. And what it does, it looks at portfolio managers from all around the world to get a sense of what their positioning looks like. And if you can see, the vast majority of investors, 68%, still think that this is a bear market rally. A lot of investors think that there's potential that we could retest the lows. And from our view, especially given what's happened over the last month, we find that can become much more difficult, especially given the policy response put in place to support and create these conditions for a recovery. But we're also going to highlight both this as well as some flows, which again has basically kept a lot of assets on the sidelines, kind of waiting for these pullbacks, and would be further supportive if any pullbacks happen. I mean, as we're speaking today, markets are quite red, and I'm sure that this is going to be investors will be salivating to try and participate and get back into it going forward from today. So if we jump to the next page, not only do we see investor behavior in terms of the view for the economic recovery, we can actually see it in terms of its flow pattern. Now, what this does, this takes a look at global equity fund flows, ex-US essentially. And what you see is that there's been a massive sell-off of global investments relative to the US, basically on par with the global financial crisis in 2008. And again, this is further supportive of the fact that this is contributing to this like stay-at-home rally. There's so much additional opportunity for assets and participation to come back into the market and support or find another leg forward in terms of that economic growth. Now, if you think about some of the investor behavior and think about some of these managers that may have missed this rally, just think about the psychology of watching as this market continues to trail away or continues to rally higher from their perspective. It's very difficult to actually sit on the sidelines trying to find those opportunities and put that money back to work to generate those consistent returns for clients. Now, if we jump to the next slide, we're going to talk a little bit about some of the policy responses that's kind of created these conditions. And now, I don't simply want to paint a rosy picture that's going to be a very simple and smooth recovery. There's still risk within the markets. And again, we'd highlight that we always try and create these diversified portfolios that can be a little more safer and consistent for clients. But I want to highlight some of the massive support mechanisms that have been put in place, which we see as being very supportive for a transitory shock and our economic recovery in the second half of this year. If you take a look at this graph right here, this is the Federal Reserve assets. So this was in response to some of the challenges that markets were facing. What you got was government response coming in support with massive liquidity injections. And they did it in such a quick time frame. I mean, the response on this one was weeks compared to months for the global financial crisis. If you power to the next slide, what you're going to see in addition to this is beyond just the monetary stimulus, but also the fiscal. You've got governments that are supporting both workers and businesses and employees with massive fiscal budgets and fiscal stimulus. This is going to be very, very supportive and help power this recovery forward. Now, in terms of talking about what's next or where we go from here, we wanted to highlight a couple of key super trends or key focuses for how COVID has kind of impacted and or even accelerated some of these super trends that we're talking about. So if you jump to the next slide, 3 of the big trends that we're talking about today: 1, more debt; 2, less global; 3, more digital. How do you position your portfolio to benefit from these 3? Now, clearly, more debt is going to lead to higher taxes, financial repression, and potentially higher inflation in the future. Now, all of this we see as consequences. I think would be a big focus for investors to work more closely with their advisors to reposition and look at what's happening in their portfolios and how they can take care of themselves for the future. In terms of the less global, we get this question quite a lot: populism, protectionism, localization. We actually can counter this with global diversification. If we do anticipate markets kind of closing their boundaries, from our perspective, from a global diversified portfolio, we want to invest in markets that have very high growth rates. And we do see that from investing around the world and including that as part of a growth opportunity within portfolios. Now, clearly, we've talked about more digital. We've all seen a lot of the work from home trade becoming very crowded and very accelerated in the tech sector and growth stocks within the US. From our view, I think that's been a very key point or pivotal point to look at. I think we're all using technology today to stay connected. For us, we definitely like tech as well as healthcare within portfolios, and we think that this trend can continue. But again, we love looking at it from a global perspective. We do think that there is a lot of crowding that's happening in the work from home trade that's going on in the US, the large tech growth sectors, and think that there's opportunity to diversify away from that. And if you jump to the next page, this is kind of shows how one of the charts that we highlight some of the change or potential change for investment leadership over the past decades. And again, there's absolutely no denying the fact that the U.S. stocks have had a phenomenal run. And even presently, the recovery from this has been absolutely phenomenal. But we think that some of the policy responses has created a potential change for leadership or investment leadership. With a lot of that new supply of money in the U.S. And the essentially resetting or repush of valuations for some of these sectors and some of these companies, that it really does create an opportunity to diversify your portfolio away from the U.S. and seek great opportunities elsewhere. Now, the focus for us, we are definitely looking at areas within Europe, which continue to see a lot of changes with respect to not only both their monetary policy, but the relaxing of purse strings for both fiscal, which we think will have a very powerful and profound impact on their stock markets. In addition, we continue to focus and look at Asian economies that have tremendous valuations, huge levels of potential growth, and also a burgeoning tech sector that is far more cost effective than that in the U.S. So again, from our perspective, we continue to see a lot of these trends, but we think there's a potential opportunity for change in leadership to focus more on a global perspective. And if you jump to the last page, this is kind of the conclusion or bottom lines. So in terms of the virus, I think that we're still going to have to live with this for some time. But again, I think the big bet here is that never bet against human ingenuity and innovation. I think that will always come back to bite you in the back. From a focus, risk markets are always going to recover before the economy recovers. Concentration risk, very, very high. At present, as mentioned, the work from home trades and the large U.S. growth sectors. And then this is an opportune time to globally diversify. And then lastly, again, stay oriented to some of the super trends from around the world, which we think are only going to accelerate in the coming years. If you're interested in some of these comments, if you jump to the next page, you'll see some of the content that we've created. Every year we create an annual super trends that highlights about a dozen trends that we're following very closely on a regular basis. We do put out kind of quarterly updates on what our portfolios are doing, along with monthly dashboards, and Ask Forstrong pieces are kind of more ad hoc, which talk a little more what's happening on a regular basis. And then clearly, we've also launched a Forstrong Global Thinking podcast, which is available on any of your podcast download sites. And with that, I'll pass it over back to you, Pablo.
Great. Thanks so much, Rob. Very insightful there as well. Just before we go on, we've got about 15 minutes left in this conversation. If you'd like to ask a question, just a reminder that there's the Q&A tab at the bottom console, so please ask a question there. In the meantime, just want to turn it back to you, Robin and Rodrigo. Obviously, you guys deal with a lot of advisors. They're dealing with a lot of apprehensive clients these days. They're scared, sitting on the sidelines. There's a lot of cash. We know that there's a lot of cash out there. When is the right time to get back in terms of the markets and with all that all the volatility we've had going on? What should advisors do? What should advisors talk to their clients about in terms of getting invested again? Rod, do you want to start us there?
Yeah, sure. I mean, if you take a historical perspective about when to put cash to work in markets, I think the stats would tell you that whether you want to kind of average in or invest at a single point in time, historically the stats would always say put your money to work given the continued upward trend of markets. Now, I get that that's not the easiest response to share with the advisors and to share with clients. From our perspective, we definitely think that there are opportunities in the market. I think that you clearly have to match up the risk profile and make sure that clients are going to be comfortable with what they're investing in. And if you can take a global and diversified approach to investing and seek opportunities from around the world, you can kind of reduce that risk burden to that client to try and make it a little bit more palatable to invest right now. So again, from our perspective, I still think this is a good time to invest, but to do it by creating a global diverse portfolio and harvesting returns from a lot of those asset classes we talked about.
Mm-hmm. And Rodrigo, what's your take on that?
Yeah, look, I echo pretty much everything that Rob said. Be as diversified as you possibly can. Be globally diversified, and also understand that a lot of people. I mean, I hope people learn their lesson, right? Understanding the imbalance in a portfolio is key. And you asked about my conversations with advisors and investors. We deal with a lot of U.S. advisors, international advisors, Canadian advisors, and a large proportion realized how poorly managed they had their risk in their clients' portfolios, losing because of the reach for yield, because the reach for yield, whether it was for high-yielding products or just simply saying bonds, sovereign bonds are not important, gold is not important, I'm just going to go toward equities, that saw a 30-35% drop in their portfolios. And when I was having the conversation back then of whether it was a good time to be diversified and go into the type of portfolio that I described, the answer was kind of like, it's any time, but it's a much tougher decision. The wonderful thing is that every investor that we talked to at the depths of this has now gotten a mulligan. It's as if nothing happened, right? Whether you were invested in a risk parity portfolio or you were 100% in equity markets, we're now kind of at the same spot. And it provides an opportunity for advisors to rethink, hopefully learn the lesson of proper diversification and risk management, and to really implement a more robust portfolio that could withstand the next COVID event without it affecting their clients fully, right? So is it the right time to invest in a diversified portfolio? Absolutely. You couldn't find better timing today, right? And then the question is, how much do you then want to try to predict the future? And I think you can find like good managers like Forstrong that have this ability and travel the world and understand kind of the future, the short-term to mid-term implications of everything that's going on to see if you can tilt your portfolio away from the diversified product. They do it by looking at these market dynamics and trying to understand all these mechanics. We do it by having understood behavioral errors that exist through factor investing on the asset allocation space and harvesting those over time. So yeah, now is as good a time as any. It was a lot tougher 3 weeks ago.
Yeah, thanks for that. So, in terms of risk, there's a lot of question about risk, given the market that we've just gone through. We do have someone here who's asking about, given the amount of, there's a significant portion of global asset multi-asset portfolios are not expected to return much after fees. So, it will be difficult to generate something close to, a normal rate of return unless you take on significant amount of risk. What's the approach that you're taking to ensure that you're getting some growth given this dynamic?
So I'll take that first, Rob. I think there's a piece and a bunch of podcasts that we've done called "It's Time to Get Comfortable with Being Uncomfortable." And I think what the listener is asking is, look, a 60-40 portfolio. You got bonds with an average yield of 0.7. You got equity risk premia at historical lows because valuations are so high. That 60-40 portfolio is going to yield very little. How are we, after fees, going to meet our obligations to the 4% rate of return that investors need in order to retire? It's a very good question. And what that requires is, in the getting comfortable with being uncomfortable piece, we say, look, your Canadian and U.S. equity-centered portfolio is at a massive overvaluation. And so you're going to need to look abroad. You're going to need to look globally for lower valuation economies, as Rob alluded to, in order to bump up your return. And it's just a very difficult thing for most investors and advisors to do when they're home country biased. It's a real thing. And so you're going to have to get comfortable with going global if you want to bump up that return. That's the first thing that we say. How else can you bump up that return? Well, you got to get comfortable with doing the research on all of these factor investing and ETFs that exist out there. These factor portfolios provide an orthogonal just means a completely independent return stream away from traditional equity beta that is going to hopefully add an extra 50 basis points to 1% to your client's portfolios a year. Now, they're complicated. You're going to need to dig deep. You're going to need to be able to learn about it and then regurgitate it to your clients in a way that they understand. And it's going to be uncomfortable for you. It's going to be uncomfortable for the clients because there's going to be tracking error to your home country portfolio. But it is time to start getting comfortable with being uncomfortable if you don't do those things. And then the final thing I'll say is that once you get to the factor investing, once you get to that point of, like, okay, so these are factor indices, then you say, okay, what else can I do? And this is when you start getting into the more obscure hedge fund space or tactical managers, learning about those managers, how good are they at predicting the future and seeing what they can do. And now it becomes an idiosyncratic risk of the managers that you choose, but you have to go there. You have to do it. It's time that the active will shine in this environment. And of course, you can go deeper and deeper into like high frequency trading and all that stuff, right? So there's a spectrum. But the last thing I'll say is that getting comfortable with being uncomfortable can also mean do nothing and say to your clients, look, you're a home country bias investor. Our expected returns are 2. You're going to need to save more and you're going to need to save more and retire later. And that's like an uncomfortable conversation. So no matter how you spin it, you're going to have uncomfortable conversations and do hard work. So if you want to learn more about it and kind of see how deeply we thought about this, look up Getting Comfortable with Being Uncomfortable and Resolve, and you'll see the many pieces and podcasts that we've done on it.
Mm-hmm. You alluded to global. Rob, you mentioned global and in terms of specifically Europe, looking at Asia. What's the prospect for emerging markets as we move ahead? Obviously, they're difficult times right now. You're looking at some of those big nations in the emerging space going through very difficult moments. China, obviously, nothing needs to be said about that given the circumstances. Brazil's going through the crisis now as well. What is your approach in terms of the emerging market outlook, and where are you looking to invest?
Yeah, so I think I'm happy to cover that one and maybe echo a little bit of what Rodrigo just said. So from our view, I mean, clearly we do like to hold asset classes from all around the world. We're not saying that we're only going to be in Europe and only going to be in Asia. We will still hold some pieces of Canada and the U.S. But for us, we're trying to find where that growth opportunity is going to come from, where that growth engine is. And if you take a look at expected GDP return pushed out into the future, I mean, you could see 3, 4, 5 times that in Asian or emerging market economies relative to some of the developed worlds, particularly the U.S. I mean, within that, you can also break down to certain asset classes to show what some of the key super trends that are happening within those countries. So clearly the market's having a hard time focusing on one thing at a time, and I think there's still going to be some challenges with respect to the U.S.-China trade war, even what's happening with regards to China, Hong Kong, and even post-pandemic. but we still see a lot of growth and opportunities, particularly within emerging market technology, emerging market healthcare, or even more particularly, like even just emerging market debt. And we talked a lot about how do you generate returns for clients or get them comfortable with their expected returns in this low rate environment. And I think Rodrigo mentioned actually a really good piece, which I'd recommend anyone to take a read, getting comfortable with being uncomfortable. And if you look at bonds in Canada and the US, I mean, they're on the floor. If you take a look at just basic sovereign or emerging market debt, I mean, this is an asset class that pays over 6% coupon with currencies that are 30 or 40% depreciated relative to Canadian dollar or the US dollar. So these are asset classes that I'm not saying put 100% in your portfolio, but these are asset classes that you should incorporate to help generate a little bit of that yield, that return, both from an income, but also from a potential currency appreciation. We do think that there's going to be some weakness in the US dollar relative to the emerging basket. And we think that's going to be very beneficial, especially given its lower correlation to emerging market debt to kind of a traditional North American portfolio. And in terms of having conversations with investors about lower rates or expectations about rates, I mean, for us, we've always kind of talked about generating a very stable and consistent 5 to 10% return net of fees every single year. And for those that we're always looking for the 15, 20, or 30%, I mean, we're clearly not for them. Like our view, our approach is very defensive in nature. We're always trying to generate positive returns regardless of what's happening in markets, and we continue to do that for today. So for us, again, I do think that if you haven't already taken a look at opportunities within Europe or within the Asian space, definitely do so and include that in your portfolio because it can be very supportive, especially given its risk and return profiles.
Great, thanks for that. So just to conclude here, want to finish up with where we started. Daniel, I want to turn it over to you. You pointed out about the growth, the substantial growth of the ETF space in the past decade in Canada. We know that it's now represents in terms of percentage of AUM versus mutual funds, we're about 12%. Where do you see in terms of the decade ahead now? We've entered very volatile times. Where do you foresee the ETF market going, and what are some of the expected or unexpected events that you may see our listeners may be experiencing in the years ahead?
Sure. Thanks, Pablo. And perhaps part of my answer can play into what Rodrigo and Rob were talking about. Well, first, I would kind of maybe allude to the chart I had, which is number 6, comparing mutual fund and ETF flows. It looks, especially if you're a mutual fund provider, kind of scary, but the reality is that ETFs are still just 10% market share relative to mutuals, maybe a little more now if mutual funds are under $2 trillion in AUM in Canada and ETFs are a little north of $200 billion, so it's about 10% market share. And what that suggests to me is that just by virtue of a traditional kind of diffusion equation or osmosis, as we would kind of analogize this from the world of physics or science, anytime there's something that upsets the apple cart or shakes the equilibrium, there's going to be people who withdraw assets from all sorts of risky areas, and then when it comes time to redeploy, they'll reevaluate. And ETFs, being relatively smaller than mutual funds, are going to be the beneficiary of this kind of process. It happened in 2008-09 when ETFs were really quite small compared to mutual funds, and it's happening now too. And throughout this crisis, we actually expect ETFs to kind of take another leg up in market share, and whatever cause of the next one might be, I would expect the same kind of trend to continue until there's some kind of equilibrium point reached, some kind of saturation point where ETFs and mutual funds can coexist, and the flow, the two-way flows kind of match one another. Where that point is, I'm not sure, but I imagine that it's quite a bit higher than the 10% we see between ETFs and mutual funds, not to mention direct security holding. So another one of the trends we're observing is that to kind of play these very uncertain markets, more and more investors, especially individual and retail investors, are gravitating to thematic ETFs. I don't have a lot of slides or material on that to share today, unfortunately, but if you look at just some of the headlines coming out of the U.S., you'll see enormous flows pouring into ETFs like jets for airlines. You'll see just today I think an article in your publication, Pablo, on the Globe, I have a quote, perhaps I think Rob also has one in that article too, on WFH, a work from home ETF that was filed. I mean, we're all extremely online now, and technology and healthcare, which were already darlings of the investment landscape before the pandemic, are now even more so than before, given the increased role technology plays in a post-pandemic world, and the role that healthcare will play in potential recoveries if vaccines are successful and so on. So, ETFs are figuring into more and more portfolios, more so than ever. But the next thing that comes after that is anyone's guess, really. I've heard mention made of direct investing or various different kinds of SMAs that use very tailored and personalized, otherwise expensive algorithms to create, tax loss harvesting portfolios on a bespoke basis at scale. So, perhaps that'll be the next thing after ETFs. Again, another fintech area that's ripe for innovation. So I think we're going to continue to see innovation. I think that the quantitative methods of asset management are going to continue to gain in prominence and mind share because they have been performing differently. And in this online world, where debates occur in social media platforms, perhaps certain kind of slap fights that have been under my team's kind of watchful gaze may not have as much of an impact in the real world of I guess people taking walks with their dogs, which is one of the few things you're allowed to still do these days. But I would say that it's a brave new world, and ETFs are going to figure very prominently.
Well, thanks for leaving us with that, Daniel. Very insightful, and want to thank you all for joining us for today's webinar, which was brought to you by Inside ETFs and Global Advisor at the Globe and Mail. A special thanks to our panelists, Rodrigo Gordillo of Resolve Asset Management, Daniel Straus of National Bank of Canada's Financial Markets Division, and Robert Duncan of Forstrong Global Asset Management. Slides and replays should be available within the next 24 hours. And once again, thank you all for joining us. Have a good day.